Why do two leading Philippine property developers, Rockwell Land and Filinvest Land, face such different borrowing costs in the same market? It's a question that goes beyond tradition, family names, and even balance sheet optics. At its heart, it's about how the bond market interprets confidence, coverage, and cash flow comfort. Factors that shape not only the cost of money, but the competitive edge of an entire business. Rockwell Land, backed by the Lopez Group, and Filinvest Land, led by the Gotianun family, share the same economic landscape. Both tap local bond investors. Both sell into a property cycle shifting with rates. Both borrow in pesos. In 2026, however, Rockwell raised 3-year bonds at 5.5666% and 5-year bonds at 5.8595%, while Filinvest Land's 3-year issue came at 7.3993%. The spread isn't just a market quirk. It's a shorthand for how investors weigh risk and comfort. On first glance, Filinvest doesn't look more fragile. Its debt-to-equity ratio stands at 0.85x, more conservative than Rockwell's 1.04x. But bond investors aren't just accountants. They ask harder questions. How comfortably can a borrower service debt when collections soften, rates rise, or new projects stretch cash flows? Here, Rockwell's advantage becomes clear. Its interest coverage ratio was 4.06x, compared to Filinvest's 1.89x. That means Rockwell's operating earnings cover interest payments with much more room to breathe. When credit markets tighten, this buffer matters. It separates borrowers with mere solvency from those with genuine resilience. Consider cash flow. In the first quarter of 2026, Filinvest paid 1.45 billion pesos in interest and transaction costs, compared with Rockwell's 587 million pesos. Filinvest's finance charges were materially higher, and many were capitalized into assets, temporarily easing the hit to earnings, but not to the cash needed for bondholders. Bond investors care about economic reality, not accounting finesse. Filinvest's capitalization rates soften the blow, but the pressure remains. Market timing also shapes pricing. Rockwell issued bonds in March. Filinvest followed in June. Changing risk appetite and rising yields can make money costlier. But timing isn't the whole story. Rockwell's 5-year bonds were cheaper than Filinvest's 3-year ones. That signals the market was pricing not just duration, but issuer-specific credit risk. Operating momentum supports this distinction. Rockwell's revenues surged 45% year-on-year in the first quarter, with net income up strongly. Filinvest's growth was steadier. Revenue up 4%, net income rising just under 3.5%. Neither is weak, but Rockwell's visible momentum and strong coverage profile speak to bond buyers in a language of confidence. There's an irony. Rockwell, known for premium projects, enjoys a credit advantage, despite the risk of concentration in high-end niches. Its margin-rich assets and compact portfolio translate to more efficient earnings conversion. Filinvest's broader reach gives scale and diversity, but also heavier capital needs and a more complex financing structure. Ultimately, the borrowing cost gap is a referendum on debt serviceability. Investors reward Rockwell for superior interest coverage, better momentum, and favorable timing. Filinvest, while larger and less levered by book metrics, carries a heavier debt service load relative to its cash earnings, coming at a steeper coupon. For equity investors, this matters deeply. Cheap debt is more than a financing detail, it's a strategic advantage. Borrowing 150 to 180 basis points cheaper helps fund land, construction, and growth with less leakage to creditors. Over time, this gap compounds. Higher returns, more agile launches, greater resilience during slowdowns. In property, money is a raw material. And in 2026, Rockwell is buying that material at a price Filinvest can only aspire to. That difference, invisible to the casual observer, is understood and priced every day in the bond market.